Good morning, everyone watching live on the BAM YouTube channel. Let me know in the comments where you are tuning in live from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will discuss the weekly inventory update, Black Knight's latest housing reports, Zillow's latest housing report, and $1 Million Homes. Today is Tuesday, March 7th, 2023. I am Byron Lazine, and the Hot Sheet starts now. Inventory has been the hot topic, and let me know in the comments if you've been following along. Definitely hit the thumbs up if you have been actively looking at what's going on with the inventory in your market. I'd love to know where you're at. Let's take a look at Housing Market Tracker from Housing Wire. They put this thing out every single week. We typically will cover it here every week, especially now because they do such a great job of getting us the up to the week inventory data. And that's what we're going to look at specifically here today. Weekly inventory fell much more than the previous 2 weeks, down 11,021. New listing growth had its lowest weekly calendar point print for this previous week as well. Okay, so inventory not going in the right direction. We've got a whole bunch of these charts for you today. Actually, we've got 10 different charts we're going to go over on this show today. Those are all available for you in the daily download link. And you can see inventory is just not heading in the direction that any of us want. We know that when we get an increase in inventory, it's going to create an easier atmosphere for buyers to get an affordable home. It's going to allow them to go out there and not compete in some of these median price points. Who in the comments would like to see some of these median price ranges loosen up a little bit? Maybe they already have in your market. Let me know. Weekly inventory change from February 24th to March 3rd fell from 429,000 to 418,000 homes. This number that we're looking at here, same week last year, was 243 to 240. It dropped last year as well. You're like, wow, we got way more inventory than last year. Is it, number one, like I've been saying the last few weeks, is it good inventory? And remember, last year was the all-time low, so we are still near all-time lows. And keep in mind as well, this number, these numbers here that we're looking at, these are the active homes on the market. Okay, so this is what's actually available. So if a buyer and a seller come to an agreement and it's a pending sale, it's under contract, it's in escrow, whatever you call that in your market, that number is what NAR uses for their data. Okay, so you can see here, NAR is gonna put a existing home number of 980,000, but that includes all of these properties that haven't closed out yet. Okay, so if you look at NAR's number, when you include all those homes, we're still at near all-time low. 2022 last year being a little bit lower, right? But we need to get back up to close to this 1.5 million, 1.4 even range for us to be in a healthier spot with inventory. Okay. New listings, they've been declining for years. And no matter where the mortgage rates have been trending, they just continue to decline. So low mortgage rate environment, new listings going down, right? A lot of people are buying these homes. Higher mortgage environment like we have right now, new listings continue to go down. We can see here from 2015 to 2018, they continue to go down. We're also in an environment right now, the last 3 years, where they're continuing to go down as well. 51,000 new listings in 21, 22, 49,000, and we're actually just below 22, believe it or not, here in 2023. Here's the Altos research chart showing us new listings being at the same mark basically of last year right now. So inventory not getting better. That we were hopeful that this weekly print would be a little bit better than last week, where we lost about 6,000. We basically doubled up the last 2 weeks in the 6,000s the last 2 weeks, and now down 11,000 here this week. I'm knocking on wood over here. I hope you're doing the same. Knock on some wood in the comments. Just write knocking on wood. We're hopeful that next week or the week after, we're going to start to see this inventory go the other direction. All right. So knock on some wood rather in the comments. I'll be hitting the woods, the fairway woods with Eric at his wedding in Arizona here in just a couple days, but I'll still be doing the hot sheet with all of you. So let me know in the comments if you appreciate that. Okay, let's move over to Black Knight's weekly monthly report. Okay, so they do a housing market index. This is from Black Knight. We're going to go over Zillow in just a second. Okay, their 2023 mortgage monitor for January. It's now out, just came out yesterday. Okay, see what Black Knight has to say. Months of supply has stagnated at approximately 3.1 in recent months. Now, we just saw a national number for 3.5, so this would be down a little bit. Falling demand has been met with a weakening inflow of new listings, with 90% of U.S. markets facing growing inventory shortages. So if you're in one of the 10% of markets, we heard from somebody in Houston yesterday who had a market that was increasing in inventory. I think it was up 17% in Houston, if memory serves me correct. 70% inventory overall, rather, and 17% new listings. What are you in one of those 10% of markets that's actually seeing inventory increasing? 90% are seeing inventory shortages right now, according to Black Knight. Through January, though January marked the 7th consecutive month of falling home prices. The months declined 0.24% from December, 0.13% on a seasonally adjusted basis, was the smallest yet in that time span of 7 months. Okay, so listen, this is in line with Case-Shiller Index, where we've seen 6 months in a row, according to Case-Shiller. Black Knight's saying 7 months now of falling home prices. First time since 2012. We've been talking about that a whole bunch here on the hot sheet if you've been following along. Growing supply shortages are holding home prices higher than they otherwise would be given current affordability constraints. I said this on yesterday's hot sheet. If we had more inventory in almost every market right now, and I said it on the Real Word as well yesterday, or actually, which will come out today. We recorded yesterday for that pod. The inventory increases, if they happen, will help prices. Okay, so we will see prices pushed down quite a bit. Not 30, 40% like some of these people who are hopeful on Twitter got their fingers crossed, but we will see prices drop if we see inventory come back on. Black Knight is saying the same thing. Here's a big one that I thought was interesting. Half of all mortgaged homes have first lien interest rates at 3.5% or below. So half of the homes that have a mortgage out there have interest rates at 3.5% or below. A full 3 percentage points below today's market rate. Okay, 2/3 are at 4% or lower. This is that standoff we were talking about yesterday on the hot sheet. Okay, 3.5%, half the homes. 2/3 less than 4%, and we know that 99% of homes are less than where we are at today. Buy-side activity perked up when these 30-year rates fell to 6, but recent data has shown that they are very sensitive at the 7. We know this. We've been talking about that. I've got a whole bunch of charts from this Black Knight data. They had, 30, 40 different charts. I've narrowed it down to the 8 that I believe you should be paying attention to, and those are going to be all down below in the daily download link. So make sure you grab those so you can get all of our sources and charts in one place every single day. Okay, for those that have been following, we've been talking about this national delinquency rate and how it is below the average of 2000 and 2005. The average is 4.61. We're at 3.38%, okay, which is, by the way, if you look at that line, a near record low. That gray line right there is the record low. We touched that just the end of last year, and now we are very near the record low for delinquency rate. We're in a very, very healthy spot for delinquencies. Anybody that tells you differently, show them this chart. Grab this, maybe use it in an email newsletter for people confused on where we're at on the strength of our mortgages in the housing market. Very strong spot as it relates to delinquencies. Black Knight is reporting that. 30-year mortgage to the 10-year treasury spread. We talk about the 10-year a lot at the end of the show. We'll tell you where it's sitting right about now at the end of the show. And you can see here, the blue line's the 10-year treasury. This is an interesting chart. Housing is going to follow the 10-year. Okay. What's different right now, which is uncommon, is that the spread, that gray bar here at the bottom, the spread is at about 3%. Okay. So you see here, we're at about 3%. We've been since middle of last year, pretty close to 3% on the spread. Historically, and I won't say that that's historically because those are COVID years, but historically, if you look at this, the spread is about 2%, 2% between the 10-year, the blue line, and the 30-year fixed. Right now, we've been operating on a 3% spread, right? If you had a 4% 10-year, which is basically where we've been at, you should see a 6% interest rate. Our 30-year fixed is happening to live at 7. So home shoppers like, what the heck? I'm really getting screwed. It's why there's a lot of belief right now that from Fannie Mae, from Mortgage Banker Association, that it's going to come closer to this historic spread of 2%, and we'll get a 5 handle before the end of the year. That's what they're projecting. Anyways, cash out refinance withdrawals. Okay. The blue bars are the total equity withdrawn via cash out refis. And then the average cash out withdrawal per borrower is the black line. I don't love how fast that's accelerated up near $100,000. People grabbing money right now out of their homes, reminiscent a la 2005, 2006. Okay. We started to see that creep up before COVID, drop back down. Now we're way up before 2006 levels and before pre-COVID levels. So people grabbing some serious amounts of cash right now, something to keep an eye on there. Payment to income ratio versus the 30-year rates. This is something we've spoken about in the past. I'm keeping an eye on that. It's not up as high as 2006, 2007 timeframe, but it's just about there, 33.2% payment to income ratio right now versus the 30-year rate. Okay, so something to keep an eye on there as we move forward. Inventory of homes listed for sale. This tells the tale that this is a local conversation of what's going on in your market, taking the national headlines, picking them apart, and showcasing to the people in your community how it may be different. Okay, so we can see here inventory of homes listed for sale, percent change from 2017 to 2019, same month average. Okay, you can see the national right here is got a declining inventory. Okay, but that is the case for Miami, Chicago, Virginia Beach. That might not be the case for all. You see, it's not the case for San Francisco. It's not the case for Austin. It's not the case for Las Vegas. And so we spoke about that earlier on the show here, where, hey, are you in one of those 10% of markets that's actually seeing inventory increase? Let me know in the comments if you are one of those 10% of markets. Number of new listings national. Okay, we covered that when we covered the Housing Wire housing tracker. Okay, 25% new listings down, difference from the same time of 2017 to 2019. Those are the key indicator because that was a more normal market. Okay, so incredible drop here on the number of new listings. It's something that we need corrected in a hurry. Here's another Black Knight chart I found really interesting. Annual home price growth rate. Okay, so this is the annual. We know that over the last 6 months, according to Black Knight, according to Case-Shiller, we've seen prices decline month over month the last 6 months. But if we go annually, you can just draw a line down the middle of the country, basically. Everything to the east is up and everything to the west is down. Really interesting. Okay, typically the east will play catch up on what happens in the west, and the west will react first, then Texas, and then you start seeing an impact on the east. We'll see if that remains to be true here moving forward. And then for all the people that say, well, what about the forbearances? Going back to the delinquencies, okay? Here's a great chart to show them. There was 8.4 million forbearances, okay? Well, 50% of them have been removed, expired, okay? Let's go to the other paid off. 34% of those paid off. There you go. 84%, not a problemo anymore. Distress liquidation, 1%. Removed, expired, 1%. Removed, expired, delinquent, 5%. Removed, expired, delinquent, 3%. Okay, so the active ones, you got 4% and 2% original term. So you got a total of 6% of these for COVID-19 related forbearances still actually active. Okay, so delinquencies near all-time low. We only got 6% of the 8.4 million forbearances that are still active. We know how strong the job market is, so you're likely to see a lot of those catch up in a hurry here, like we've seen over the last few months with delinquencies, and we've talked about that on the hot sheet. Okay, if you want to be an expert, you should be staying tuned into this. Hit the thumbs up if you agree, and make sure you're subscribed. We also have an expert panel of predictions from Zillow. Zillow put out their what's it called? Home price expectations, their ZHPE, their surveys in. Just came out yesterday. This is on nowbam.com. We'll link it in our source link down below. Okay, so this is where home prices, according to the Zillow experts, are going to go over the next year. Housing economists surveyed by Zillow predict home prices will bottom out in 2023, falling by 1.6%. Okay, Zillow as a company says they actually believe home prices are going to increase just a little bit, but this is from their panel of experts and economists, the experts out there. All right. Then they think it's going to grow an average of 3.5% from 2024 to 2007. They also forecast a slide in home sales to 4.2 million for 2023, down from 5 million in 22. 63% of the panel expect the 30-year fixed rate to hit its highest point for this year in quarter one. Hey, good news is we only got, 25 days, less than 25 days, 20 days of quarter one to go. So we're almost out of the woods on the high point of the 30-year fixed. I like that. Let's cheer it up in the comments for that. 63% of the panel expecting 30-year fix hit the high point. Okay, the median respondent expecting a 6% rate at year's end. That'd be a full point lower than it is today. That'd be good news. Here's the U.S. home price scenarios. This will be down below for you. Okay, yellow, all panelists. This is the mean. Okay, home price scenarios, projected U.S. home price growth. Okay, so 2022, we know what happened there. Now they're talking about 2023. The pessimists believe 0.1%, minus 1.4 for 2004. You can see the blue line there. These optimists, boy, they think 2027, you could have another 40% growth by 2027. This might be a chart to show some buyers who are worried about, what if I buy now and I'm only going to be there 5 years? Well, a panel of experts that Zillow put together says you could join. The optimists believe you could get 43% growth, and the pessimists believe 7% growth by 2007. Okay, active annual growth rate pre-bubble 87 to 99 is that gray line, which would tell you you're going to end up at about 23% growth if you buy a house today, and then what's it going to look like in 2027. All right, so there you go, some more information to arm yourself to have these discussions with people who are timid about what the future brings. Jeff Tucker, Zillow senior economist, the housing market is resetting. I don't know, Logan over at Housing Wire and the Fed would tell me it's already reset, but maybe we're at the end of this resetting. I'll give you that, Jeff. Though we're seeing early signs of renewed buyer interest early this year. Yep, we've been talking about that on the hot sheet. Prices should generally flatten out in 23, helping buyers catch up. The sheer number of people in the first-time homebuyer age range and lack of inventory should limit price declines. A return to more normal growth would be welcomed after a roller coaster ride home prices have been on lately. There you go. That is down below if you want to grab that chart and use that in any of your marketing, or certainly with buyers who are eager to know what the next 5 years of their home values would look like. Okay. Maybe, just maybe, if you buy in the right price range, it'll be over $1 million. Redfin just reported yesterday that $1 million homes are less common as mortgage rates cool the market. Okay. So what does that mean? A share of US homes worth at least $1 million has fallen to 7% from 8.6% last June as the housing market cools. Okay. That's up 4.2% from before the pandemic began. So of all the homes, 4.2% of them before the pandemic began were $1 million plus homes. 7% about a year ago. We got up to 8.6% middle of the year last year, and now we're back down to 7% of all homes are $1 million homes. $1 million plus homes making up a smaller portion of the housing pie than they did in the spring is an illustration of a cooling market. Buying an $800,000 home today would cost more than buying a $1 million home a year ago. The Bay Area, Seattle, and New York are losing $1 million homes the fastest, while Florida is home to more $1 million homes than a year ago. We a couple weeks ago on the hot sheet, we talked about how Florida's got 9 of the 12 highest neighborhoods. So that would make sense. And particularly on this topic, Nicole and I go very deep on this topic as a racket on the Real Word, which is going to premiere today at 2:00. So make sure you tune into today's Real Word at 2:00. Also, make sure you hit the link below where you can get signed up for Eric's webinar. Okay, but this is the last live Q&A the broke agent will be doing for the next 2 or 3 weeks before he goes wedding mode and honeymoon mode. I never took a honeymoon, but Eric, over here is the broke agent. He takes a honeymoon. Okay. All things Instagram Q&A, him, Matt Leonetti, and Brooks Landry, Wednesday, March 8th at 1:30. That's going to be happening tomorrow at 1:30. There's a link below so you can sign up to that. That'll be a live Q&A. Okay, let's see where the 30-year fix ended off yesterday. End of close, we had a 10-year that was just under 4%. We'll track that and see what happens with that as we go throughout the day, obviously. And then the 30-year fix yesterday had 2 readings. It came in at the first reading at 6.95, and then it went back up to 6.99 on the 30-year fix. So be interested to see where it comes in today. Probably wouldn't expect too much movement. Yesterday, 2 ratings moved back up to basically 7%. That's where we're at. We know what we need. We need more inventory, which will help push prices down. And then that would give indications to the Fed later this month that, okay, what they've done is working and maybe they can loosen up so we don't continue to see a rising or interest rate. Okay, there you go. That's today's hot sheet. Appreciate you guys. Make sure you're subscribed to the channel so you don't miss anything. We've got a big week coming up, finishing off, and I will see you again tomorrow live at 9:30 Eastern. Until then, toodaloo.